This week we saw the ADP jobs report come in better than expected, but today jobless claims, they were better than expected, but they still went up. So what does this mean for tomorrow's big jobs report?
Well, there's a real divergence over the last 2 years between the data that's generated by ADP and the data that we get from the Labor Department. I think on average there's about a 66,000 difference month to month in those two surveys. So the ADP, in fact, is not a reliable leading indicator of what we're going to hear tomorrow from the Labor Department. Regarding jobless claims, what's interesting to me is that jobless claims have been essentially mired in an 8-month trendless consolidation, a consolidation that began early this past February and which continues through the data we got this morning. And that, to me, is a great illustration, technically, of the grave stagnation, if you will, to which our Fed chairman referred in his speech in Jackson Hole. Now, jobless claims, as you know, are a high-frequency leading indicator of payrolls and the unemployment rate. Today's number means nothing for tomorrow's report, but the trendlessness in the behavior of claims suggests that, at least for the foreseeable, you will see little or no sustainable material improvement in jobs growth.
Now, tomorrow, the Bloomberg consensus is that 113,000 jobs will be added and that the unemployment rate will stay at 8.1%. But what does that mean? Does it do anything? Does it mean that QE3 is going to be needed and necessary?
Well, my view is that relative to monetary policy, and irrespective of how the markets respond to tomorrow's report is irrelevant for the Federal Reserve and QE3. Why? Because the Fed has clearly stated that it's only when they see substantial and sustainable, keyword sustainable, and I would add self-sustainable improvement in the economy at large and in the labor market in particular, that they would begin to withdraw some of the accommodation.
Yeah, speaking of QE3, it doesn't seem like it's having an impact on the stock market like other QE versions of QE have, but this QE is focused on mortgage-backed securities. What are you seeing there? Is there an impact there?
Well, yesterday we published a report and we called it the early returns QE3 an instant success. And what we were simply referring to in that report was the significant decline since QE3 was officially announced and launched in the yields on mortgage-backed securities. That's an immediate target of QE3. Secondly, a meaningful, albeit lesser, decline in the average rate 30-year fixed-rate mortgages for home buyers. We also saw, predictably, a big surge and, in fact, a breakout in refinancing applications, which is very bullish, in my view, for the big mortgage lenders.
Okay, so what's the stock play on QE3? Do you buy the mortgage lenders?
Yes, we've been bullish on premier mortgage lenders, generically speaking, prior to the official announcement of QE3, because we anticipated that based largely on the minutes of the August 1st meeting, which we think telegraphed it, and also, of course, based on Ben Bernanke's speech in Jackson Hole on August 31st. And we remain bullish on premier mortgage lenders.
And can you still buy them here?
Yes.
Okay.